Hey guys, welcome to today's video where we talk about consistency in investing. If you keep up with our videos, you hopefully have noticed that we try to post videos on a range of different topics when it comes to finances. And fortunately or unfortunately, some of those videos are just naturally going to be more complex than others. If I'm talking about investment theory, that's going to be more complex than if I'm talking about budgeting principles. And today is one of those videos where we are going to get a little deeper into investments by talking about a term called dollar cost averaging. And dollar cost averaging is a method of consistent investing that people utilize with the hopes that it takes out some of the volatility that comes naturally with investing in the stock market. So you've probably heard the term buy low and sell high. That's what people will tell you to do when it comes to your investments. And unfortunately, it is very difficult to time the market and figure out when those times are that you're buying low or when you're selling high. And it's also pretty difficult at times to figure out or have the discipline to invest with consistency. So not only can I not time the market, but I now have to have the responsibility of making sure I can put money towards the market every single month. And that can be difficult to do. But if you can find out a way to do that, it takes out some of the human error that comes with trying to time the market. And dollar cost averaging is the term that they've attached to this method. And I want to talk to you about how that works. But first, let's go over or recap some of the ins and outs of investments in general. If you saw our video on the basics of different types of investments, you'll remember that purchasing a stock is when you buy ownership in a company by purchasing one of their shares. Now, a number of factors can affect the prices of those shares, such as the performance of the company or even the stock market in general. Mutual funds also have shares, and those shares have a price as well. So again, a mutual fund is when you and other investors put your money into a pool, and that pool is invested in a basket of securities, which could be stocks, could be bonds, could be more. A mutual fund's price is called its net asset value per share, and it's determined by calculating the mutual fund's net worth, or what it has minus what it owes. You divide the number of shares they have out there, and by that, you have their net asset value. So, for example, if a mutual fund has $100 in assets, you subtract $50 in liabilities, and they have 2 shares outstanding, its net asset value per share is $25. This is the cost of this mutual fund. Remember, if the value of these investments increase, the person with the most shares will have the greatest benefit. So let's stick with that $25 a share and show you how consistent investing could possibly reward you. Many of us scrape and scrap together money when we can, and it can lead to us putting money into the market some months and not investing in other months. But let's take that same mutual fund and assume that its price is fluctuating over the course of 4 months. Now, these fluctuations are going to be huge, but that's for my easy math. Don't go looking for some mutual fund that does this. But let's say in month 1, the share price is $25. Month 2 is $10. Month 3 is $50. And month 4, it's $15. Now, the total price of these shares over 4 months was $100. So let's say that you and your friend both decided to invest $400 in this mutual fund over the course of 4 months. And your friend doesn't do this consistently. They don't manage their budget, they can't afford to invest every month, so they invest $200 each in months 1 and 3, but they aren't able to save in months 2 and 4. Now, in month 1, their $200 would have bought 8 shares, and in month 3, it bought 4 shares. So they have 12 shares in total. You, on the other hand, you decided to invest your money more consistently. So you put $400 aside, $100 each month into this mutual fund. Even though this means you purchased less shares in months 1 and 3 when the price was higher, you take advantage of the lower months as well and purchase 22.67 shares in total. So not only is that more shares, by investing every month, you've also reduced your chances of investing large lump sums at the wrong time. It's important to note that you could have a friend or another person or even yourself try and time the market or not invest consistently, not use dollar cost averaging, and it works out perfectly in their or your favor. It is hard to time the market, like we said, but there is always the possibility that somebody comes and puts a lump sum in at the right time, and it works out even better for them than it did for you or the person who was using dollar cost averaging. There are no guarantees in the market, but there is the possibility and the logic that says that if I can take some of my decision-making process out of it and make sure that I'm putting that money in consistently every month, then over the course of the years, hopefully it works out in your favor. And that is why we want to talk to you about some of these terms. So now that you hear the term dollar cost averaging, you can equate that with making sure that you put money in the market as consistently as you possibly can, because that is the essence of what dollar cost averaging is. We hope that you enjoyed what you heard today. If you like what you heard, please share it with as many people as you can. We want to help as many people as we can. And if you have a topic you want to hear more about, you can do so by going to my website, www.brentonharrison.com. And under the blog section, there's a questionnaire for topics you would like us to cover in the future. I'll see you guys next time.